Shri Anant Goenka ji, Senior Vice President FICCI, Shri Sunil Sanghai, Chairman FICCI Capital Markets Committee, Abha Seth ji, ADG FICCI, Shri Ashish Kumar Chauhan, MD and CEO NSE, Shri Vijay Chandok, MD and CEO NSDL, Shri Nehal Vora, MD and CEO CDSL, leaders of India Inc., market participants, members of the media, ladies and gentlemen. I am delighted to be here at CAPAM 2025. Thank you, FICCI, for the opportunity to share my views on the conference theme, Driving Growth Through Innovation, Technology, and Transparency. This theme is not merely a catchphrase. To me, it's a collective paradigm that the capital market ecosystem needs to adopt and achieve. Today's deliberations in several sessions are for constructive engagement and reflection, for asking questions and finding answers, for identifying challenges and opportunities, and for raising doubts and providing solutions. As you all know, India's securities market has scaled rapidly. We are looking good on several key parameters, such as number of unique investors, 13 crore or about 130 million. Mutual fund investors, 7 crore, which is about 70 million. Healthy primary market, which is 4.3 trillion rupees raised in FY25. A strong fundraising pipeline, 1.4 trillion rupees can be raised going ahead. Equity assets held by FPIs is 72 trillion rupees, and ownership in listed entities by domestic investors as of June 25 quarter of 19%. We have growth momentum with us. It's time to convert it into a flywheel. Robust regulatory framework that increases transparency and technology, which in turn increases trust in the system and a greater investor participation and a deeper and more liquid market, a better price discovery, the lower cost of capital, and in turn, greater investment and innovation. I note that there are interactive sessions on two critical areas today. One is on financing the future, and another one on sustained capital formation amidst rising domestic participation. I'm sure the panelists will provide their valuable insights on a range of issues such as mutual funds, AIFs and other new instruments, corporate bond market, municipal and infrastructure financing, investor awareness and education, and responsible diversified investing. Key questions for you to reflect today: which reforms are necessary to incentivize and actively engage capital issuers and long-term investors on a sustained basis for faster capital formation? The second, are our incentives, disclosures, controls, boards, and capabilities aligned to our aspiration of a much larger and deeper capital market? What efforts do we need to make? Innovation. For what? To cut friction, deepening and diversifying markets. Innovation in capital market must lower friction and compliance costs for issuers, investors and intermediaries while managing the risk. It should also provide diverse range of opportunities depending upon risk appetite. That's the bar we must set for ourselves. At SEBI, We have worked to shorten IPO timelines to enable safeguards such as blocking of funds and direct payout, and to establish digital processes that reduce cost and time for everyone. The UPI valid subsystem for SEBI registered intermediaries will soon be rolled out as a verified payment channel to protect investors in securities market from cyber frauds. It will come into effect as of 1st of October 2025. SEBI has already issued the necessary guidelines in this regard. These steps matter to first-time investors and to institutions that manage risk. Innovative regulatory approach has helped establish new asset classes, new class of investors, and new methods of raising risk capital. AIFs, REITs, InvITs, SIPs, SIFs, PMS, these acronyms now occupy important place in Indian capital market. We need to constantly create new products and new opportunities while co-creating with industry and investors optimum regulations for such growth areas. With a booming IPO market, investors are eagerly anticipating what is next. Yet, pre-listing information is often not enough for investors to take an investment decision. Can we think of an initiative on a pilot basis for a regulated venue where pre-IPO companies can choose to trade subject to certain disclosures? Here are some key challenges. Which are the unnecessary processes and pain points that cause avoidable friction in fundraising, disclosures, and investor onboarding, and how they can be removed? Which emerging areas, products, and asset classes can be developed for creating both demand and supply of capital? Let me come to technology, the second part of this theme for today. Technology is a trust multiplier, not a showpiece. Indian capital markets have constantly evolved technologically. Great tech starts with having the core infrastructure in place, reduced settlement timelines, direct payouts, resilient MI systems, market surveillance, and grievance systems. SEBI has been in the forefront of applying and promoting SupTech and RegTech solutions. That is how investor trust multiplies. But trust fails at the edge, where investors meet the market sometimes. There are many instances of fake apps, cloned websites, and unregistered entities misleading investors. We are working with social platforms to take down misleading market content before damage spreads. We'll intensify our investor awareness and education campaigns on pernicious cyber frauds. Scores has been revamped to cut grievance timelines. Smart ODR is live and has resolved 7,000 disputes worth about 500 crore. These are safety nets that give first-time investors the confidence to stay invested. On the industry side, we expect clean edges, no unregulated advice, clear and timely disclosures, and visible SEBI registration details on every app, site, and social media handles. We have to address the rise of artificial intelligence. AI has the potential to unlock new forms of customer engagement, enable alternate approaches to risk assessments, and monitoring, fraud detection, and financial inclusion. At the same time, increased adoption of AI could amplify existing challenges to data protection and cybersecurity, among others. We have to think of AI as an assist, not a substitute for judgment. SEBI's proposed guiding principles for AI/ML emphasize a tiered approach, data and cyber controls, and clear accountability. RBI's Free AI Committee report also complements this. The message from regulators is consistent: adopt AI, but with safeguards. The quick question here: are our organization and boards equipped to guide on responsible AI adoption, to balance innovation with accountability? Transparency, the third theme of the conference today, the welcome mat. Transparency is how first-time investors say yes. For new investors, three things matter: clarity, comparability, and fair rules that are enforced. As a system, we need to push for clearer communication with investors, faster rumor verification, and incentive disclosures so investors know who gets paid for what and when. If a SEBI-registered intermediary offers services outside SEBI's ambit, it must say so upfront, along with the risk and recourse. Transparency attracts long-term capital, keeps capital durable, and widens retail ownership. SEBI's regulatory approach has been and will remain consultative. A thought for discussion here: how can our platforms make new client onboarding easier without mis-selling? Let me come to way ahead. The task of capital formation in the face of global headwinds, in the era of geopolitical and geoeconomic fragmentation, is a daunting challenge. We need to put our heads together to meet the challenge. At SEBI, it has been our conscious effort to simplify and rationalize our regulatory framework for ease of doing business, without diluting our firm resolve for investor protection. Between March and June 2025, we have approved several ease of doing business proposals for listed companies, AIFs, and FPIs. Our momentum toward optimum regulation continues. We have already issued multiple discussion papers in consultation with industry and public to carry out further simplification and promote capital formation. There is much we can achieve together. SEBI's approach in relation to equity derivatives has been thoughtful and consultative. We are looking to deepen the cash equities market, which is the true foundation of capital formation. Volumes in cash market have grown rapidly, doubling in terms of daily traded volumes over a period of just 3 years. However, much more needs to be done. We have often stated that equity derivatives play a crucial role in capital formation, but we must ensure quality and balance. We will consult with stakeholders on ways to improve, in a calibrated manner, the tenor and maturity profile of derivative products so that they better serve hedging and long-term investing. Ensuring risk awareness and suitability is equally important, and constructive ideas for proper stakeholder engagement will be much needed to achieve this goal. I'm sure the deliberations today in CAPAM conference will enrich the discourse and provide key takeaways for us all. Thank you. Jai Hind.